Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, March 29th at 12:30 p.m. in New York. So let's get after it. At this point, the bullish narrative of a fading pandemic, reopening economy, and plenty of stimulus is very much the consensus view. That doesn't make it wrong, but markets are discounting machines and may already reflect the speed and scope of recovery at this point. So far in 2021, equity markets have continued to advance, but with sharp rotations that have left many portfolios upside down, like the participants who decide to run with the bulls every year in Spain. Much of these rotations were fundamentally triggered, but fueled by technicals on price momentum. So what's next? As the economy actually reopens, we are likely to see consumers behave the way investors have acted over the past year. As we've stated many times, it's much easier to turn off an economy than it is to start it up, particularly from a standing stop. As a result, some consumers and businesses are likely to be stampeded as they deal with supply shortages. This means higher costs or even missed sales altogether. We suspect these higher costs will not be passed on completely and believe incremental operating margins may have already peaked for the cycle. Furthermore, the anniversary of last year's recession trough is now and marking the peak 12-month rate of change in many key variables for the markets. These include fiscal spending, equity inflows, the Fed's balance sheet, earnings revision breadth, and many economic data series, including purchasing manager indices. Typically, a rollover in the growth of such variables is likely to have a negative effect on asset prices in the near term, even though it's far from the end of the economic cycle. Instead, it's the normal transition we see at this stage of a recovery. In short, expect a shift from early cycle economic conditions to more mid-cycle characteristics. As discussed in last week's podcast, we think this economic cycle will be shorter than the prior two expansions for many reasons. First, the last two cycles were exceptionally long in duration at roughly 10 years. This is not normal and was a product of slower than trend growth and inflation. These conditions allowed the Fed and other central banks to remain extremely accommodative with monetary policy for longer. Due to the extraordinary fiscal support and potential supply shortages, we expect better than trend growth and inflation. This means the Fed will be responding with tighter monetary policy sooner than many expect, including the Fed itself. Second, real investment has been absent for the past decade as companies outsourced production and focused on financial engineering and cost-cutting as a means of enhancing shareholder value. The pandemic has exposed the misgivings of such a strategy, and that means a higher velocity economy that is prone to more frequent booms and busts. This is another way of saying shorter cycles. The good news is that this can still be a profitable investment environment if one is willing to be more tactical and flexible, rather than simply buying a handful of investments and then sitting on them for a decade. In the near term, we are recommending investors avoid smaller cap stocks, particularly the Russell 2000 index, as these companies will struggle more than the average with increasing costs and supply shortages. On the positive side, we found that quality stocks tend to outperform with slowing rates of change in inflation, personal income, purchasing manager indices, and GDP. Therefore, move to upgrade your portfolio and move up the quality curve. One area in particular that looks attractive to us is consumer staple stocks. This is a sector we have not been recommending since last April, as it typically underperforms when coming out of a recession. It has lagged significantly, but now offers a good risk-reward as the economy reopens and markets get a bit more defensive. Other areas that could start to perform better include REITs and healthcare. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.